Hello, it's Guy, and I'm going to go through today all of our different investment partners that we raise money for. And I'm just going to give you a little background when we worked with them, so this will kind of fill out who they are and what they do. So Edgewood Management we started working with in 2006. They are a New York City-based investment firm. So they were founded in 1974. Alan Breed took over for his father in 1994. His other partners, Larry Creel joined in 97, Kevin Seth in 1995, Nick Stevens was there in 1984, and Peter Jennison and Alex Farman joined in 2006. What Edgewood is all about is growth stocks. So they own growth stocks. They own companies that are growing their earnings on average 18%. So these are some of the most dynamic, best businesses on the planet. Today they manage over $50 billion. We started with them when they were $3 billion. So they've grown dramatically. They only own 22 stocks, not 21, not 23. They only own 22 stocks. And they're divided across buckets of growth. So they'll own a third of the portfolio when they grow their earnings 10 to 15%. So they're steady Eddie growers like American Tower that owns cell towers, and they have long-term contracts with AT&T and Verizon. They'll also own a third of the portfolio between 15 and 20%, and then another third 20% plus. So it balances out the growth in the portfolio. They have roughly 40 employees today. They have a 6-person team that how they make decisions, so it's a 6-0 vote. But the most important takeaway that you want for who is Edgewood, they're a growth equity, large cap growth equity investor. They're one of the best in the business. Like I said, they've been around a very long time. They've had a lot of longevity. They only manage one product. They have a mutual fund that we started with them, and the mutual fund was $25 million. It's now $27 billion as of 3/31/2021. And then they also have a separate account business. So we raise mutual fund capital for them as well as separate accounts. So that's Edgewood Management, headquartered in New York City, 535 Madison Avenue. The second firm we started working with in 2009, Hamlin Capital Management. Hamlin has 2 strategies they manage. So one, it's kind of the opposite of Edgewood in terms of their growth, Hamlin's value, but they want to own a portfolio that has an average dividend yield versus the S&P 500 of 2 times. So let's say the S&P dividend yield is 2, they want to have a dividend yield of 4. So they invest in dividend stocks. So that's Hamlin, dividend stocks. Mostly valued, I think there are about 28 stocks today in the portfolio. Hamlin also manages a municipal bond strategy, and they invest in senior living facilities, charter schools, and correctional facilities. And that delivers about a 6% tax-free income. And so they have 2 strategies. So they too are based in New York City. Mark Stitzer is the CEO, and they have about 25 employees. And they have a mutual fund on the dividend side. So the mutual fund's about $650 million. We've raised them about $2 billion. So when you think Hamlin, think yield, so dividend stocks, municipal bonds, mutual fund about $650 million, and they also have separate accounts that we market for them. Next up is Spyglass Capital Management. Jim Robillard, the founder of Spyglass, had been at Edgewood since 2001. Edgewood did not want to do a mid-cap growth product. So what that means is Edgewood invests in companies above $10 billion. Generally, Spyglass invests in companies below $20 billion. They don't really want to invest in anything above $20 billion. And that's mid-cap, so it's a market capitalization differential. Jim decided to leave Edgewood and found Spyglass in the fall of 2015. So he hit his 5-year anniversary last fall, and he owns 25 stocks that are all mid-cap growth stocks. These are unbelievably cool businesses that are growing, and a lot of times we end up using their services like DocuSign and others. Jim has done a spectacular job. He is now over $4 billion in assets under management. Spyglass is based in San Francisco. Their offices are in the Presidio. They have about a 12-person team, and they have about $2.2 billion in their mutual fund. They have about $1 billion in a UCITS, which is a non-US mutual fund. So if you're a European investor, instead of going into a mutual fund, you go into a structure called UCITS, UCITS. And he has about $1 billion, and the rest are in his institutional separate accounts. He's growing his business nicely. He owns some great businesses. He's had unbelievable performance, and it's a great firm. So Spyglass, San Francisco-based, mid-cap growth. Next up, Hardman Johnston. So I'm going to have to give you a little history here. So the history of Hardman Johnston is this. It's our own mutual fund. So the advisor is Dakota Investments. And we formed the advisor in the fall of 2017. We launched the mutual fund on February 14th of 2018. However, when we launched that mutual fund, it wasn't for Hardman Johnston, it was for another firm called Edgewood Investments based in Boston. And we launched on the 14th of February 2018 with $100,000 in the mutual fund. Remember, it used to be back then called Marmont Partners, and it was called the Marmont Edgewood International Growth Fund. However, 3 weeks into our launch, the team at Edgewood who was managing the portfolio left. Well, that creates a big problem. So we stuck with them for a year. Unfortunately, the performance was very average, and so we were either going to shut down the mutual fund, lose all our money, or find a replacement sub-advisor. And if you've watched any of the investment term training that I've done, you'll know that there's the advisor of a mutual fund, and if that advisor doesn't manage the assets, they hire a sub-advisor. That's exactly what we did. We formed the fund as the advisor, hired Edgewood as the sub-advisor. So in the summer of 2019, we sought to replace our sub-advisor. We had a very difficult time, but we finally found a firm in Greenwich, Connecticut called Hardman Johnston. At that time, they managed $6 billion, and what they do is they do international growth. So they're very similar to Edgewood, whereas Edgewood is just US companies. Hardman Johnston is just non-US companies or companies in Europe and Asia, so emerging markets as well. So developed Europe and then Asia, so emerging markets. And so they agreed to take over as the advisor, to the sub-advisor of the mutual fund. However, we changed the name. The advisor is still Dakota Investments, but we gave Hardman Johnston the entire name. So now the mutual fund, which relaunched with Hardman as the sub-advisor on 1/1 of 2020 with about $1.1 million. We ended 2020 with about $25 million, and at the end of March 31, 2021, it's about $48 million. So Hardman Johnston, they're Greenwich-based. They now have $9 billion under management. They own 24 stocks, international growth, great performance, great firm, very similar to Edgewood in nature, but they just do non-US investments in terms of companies. So next up would be Matterhorn. So Matterhorn is a Conshohocken-based direct lending firm. It was launched in the first quarter of 2020, and it's managed by and led by CEO and CIO Trey Ott. What Trey does, it's a very cool strategy. Trey extends loans to individuals and businesses that need short-term money, and it's typically at a very high interest rate, kind of between 13 and 20%. However, it's only for 2 years, so the duration is only 2 years, which is very important in fixed income investing or direct lending. It's very short term, which means you're going to get your money back quickly. The people that need it don't want to sell equity in their business, but they have a healthy business. And what they end up doing is Trey collateralizes those loans against real estate, against the receivables or inventory of the business, and in some cases a personal guarantee. Why this is such a special strategy is because with interest rates now near zero, you're able to get a 13% net return, kind of 1% a month, with very short duration. So typically to get that kind of a return, your money has to be locked up for 5 or 8 years. In this case, it's just 2 years, a very short duration. So he extends the loans, they pay back the loan, and then he redeploys that capital. So that is Matterhorn. Now you're also going to hear about a couple of other firms that we work with. You're going to hear about Otter Creek. So Otter Creek is a long-short equity firm based in West Palm Beach, Florida. Now, importantly, Otter Creek only has a mutual fund, and that's how people invest with them. It's basically a hedge fund strategy in a mutual fund. And so effectively they go long, they're basically long growth stocks in some cases. Well, it really depends upon the day, but there'll be long stocks that they think are going to go up, and they'll short stocks, if you will, that they think will go down. And so they create this balance, if you will. And it's called a hedge fund, but it's in a mutual fund format. They have a relatively small team of 5, and it's run by Tyler Walling, and that is Otter Creek. And then also we work with a firm called Millennium Bridge. So when you think Millennium Bridge, I talked about this in the training, they're a private equity fund of funds. So Millennium Bridge is a team that came out of the state of Wyoming Mineral Trust. They worked there for 17 years, investing $250 million that they turned into $1.2 billion. And they made 44 private equity fund investments, and they made 36 secondary investments. 36 co-investments. So what that means is that when you invest in a private equity fund, sometimes there's opportunities to invest alongside the private equity fund. So for instance, let's say the private equity fund makes 10 investments. Well, you're invested in the fund with them. Well, sometimes they'll carve out ABC company and say, hey, you can also invest additional capital into these co-investment opportunities. And so that's what they did in terms of co-investment. So it's a great strategy for an institution or an individual who wants to get really rapid diversification and get exposure to, so roughly each portfolio might hold between 15 to 20 investments, private equity fund and co-investments. And so they get private equity exposure diversified by investing with Millennium Bridge. So that's a recap of the managers that Dakota Investments works with. And so when you definitely want to think of Dakota, we are a sales consultant to investment firms. In some cases, we get hired to do the sales, marketing, client service distribution for firms. In other cases, we get hired to deliver information and insights on allocators. In this case, this is Dakota Investments, the investment sales team who's out raising money for the firms that I just went through. You have Edgewood, Hamlin, Spyglass, Hardman Johnston, Matterhorn, Otter Creek, and Millennium Bridge. And that's the lineup of the firms that we work with. It's not a business we have an interest in adding new firms to, but more or less growing what we have on the platform. And that's how we expand the business, is raising more capital for the firms that we have on the platform. So that's Dakota Investments.